Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you're new here and enjoyed today's video, be sure to hit like and subscribe down below. But for now, let's get into it. So today we're going to talk about one of the most commonly used valuation metrics out there in the stock market, and that's the PE ratio. So what the PE ratio stands for is price to earnings ratio, and the formula is basically that simple. So it's a ratio of how much the company earns each year versus the price that investors are willing to pay for shares in that company. And it's sort of a quick and dirty valuation metric that's used, but I want to run through some of the more detailed uses of it and things to watch out for with the PE ratio as well. So just to run you through a quick example of how you might calculate a PE ratio for a company is if a company earns $100 per year and they're currently selling in the market for $1,000 per share, then 1,000 divided by 100 equals a PE ratio of 10. So what you might hear on CNBC and all those sorts of things is you'll say that people are paying a PE of 10 or a multiple of 10 or a price to earnings multiple of 10. All of that stuff means the same thing, and they're talking about this PE ratio. So how much are people willing to pay for those cash flows in a company relative to what they're earning. So assuming that the earnings of the company can stay consistent over time, the PE ratio will give you the exact sort of number of years that it will take for a company to basically pay back in earnings all of the amount that you paid for that company. So if you pay, in the previous example, if you pay $1,000 for that $100 of earnings and the company continues to earn $100 a year, it's going to take you 10 years to get all of those cash flows back that you initially paid up front for the business. So that's what the PE of 10 means. But when you go out and practice and sort of look at the ranges of PE ratios that companies are trading for, you'll see some pretty massive ranges. So you might see that companies either have no PE ratio, so we'll get into what that means in a sec. They might have no PE ratio, they might have a PE ratio of less than 5, they might have a PE ratio of 20, or they might even have a PE ratio of 100 or more. And at first glance, you'd be thinking, well, I want to get the biggest bang for my buck. I want the most earnings possible for the lowest price. So why don't I just go and buy a whole bunch of low PE companies? If I can pick something up with PE of 5, I'm going to get far more earnings relative to each dollar I invest up front than investing in something with a PE of 100. But there's some things that the PE ratio doesn't quite pick up. So let's get into the reasons why you might not necessarily invest in a low PE company over a high PE company. So if a company has no PE ratio, typically what that means is they have either zero or negative earnings. So when you go to calculate a PE ratio, you're looking at the price and you're looking at the earnings. If earnings are greater, the higher the earnings relative to the price, the lower the PE multiple. So if a company earns $500 and you pay $1,000 for it, that's only a PE of 2, whereas if the company earns $100 and you pay $1,000 for it, that's a PE of 10. Where you can't actually calculate a PE ratio is if the earnings are negative. So I really try and avoid companies that aren't making money. So if you do see that the PE ratio is blank or it's 0 or something like that, that's probably what's happening. So the burning question here is, why would I be willing to pay a higher PE ratio versus a low PE ratio? And it all essentially comes down to one thing. And that is something called growth. So, up front, it seems like you might want to buy companies with low PE ratios because you get the largest amount of earnings up front relative to what you pay. But the PE ratio doesn't account for growth in companies. So, if you buy a company with a low PE, let's call it 5, generally speaking, those earnings probably are not growing in the company. So if it earns $100, it's probably going to continue to be $100 year in, year out, and it may even actually be declining. So if a company's earnings are going downhill, and in a few years' time they're only earning $50, then that's not a good thing long term for investors. That company is heading towards bankruptcy. They're going to be restricted in terms of how much they can pay out to you in dividends and how much they can allocate to grow the company and do share buybacks and all those sorts of things. So that's not a situation you want to be in. And if you see a company with quite a low PE ratio, a beaten down PE ratio, it's pretty likely that that's going to be what's going on. So a company with a much higher PE ratio is exactly the opposite. So if a company's earnings are expected to grow, so if a company is going to go from $100 of earnings to, let's say, $1,000 of earnings, it makes sense that you're going to be willing to pay a lot more for that company than the one that's earnings are going to go downhill to $50. That just makes sense. Obviously, long term, you're going to do better, generally speaking, with companies that have growing earnings versus companies that have declining earnings. So that's one thing to keep an eye on, and typically that's why companies with high PE ratios tend to have better growth prospects, but they also can have PE ratios that get completely out of control. You definitely don't want to pay too much for a business. So if you get a PE ratio that's extreme, that's probably not going to turn out good for you either. So I'm going to run you through a quick example of that so you can see what to look out for. So in the United States, which is a market that I follow quite closely, and I follow a lot of companies within the US market quite closely, so there's a couple of metrics out there that give us quite a cool rule of thumb. So over the last 100 years or so, the earnings of the companies in the US stock market have grown by around 8% per year. So they're growing around 8% per year. From that, we can actually figure out a total PE ratio for the entire US market. And typically this has been around 15. So what you'll notice from that is that 15 is approximately double 2, is approximately double 8, and that gives us quite a cool rule of thumb, which when you go out and look at companies in reality, turns out to work pretty well. So typically what I like to do is if a company's earning 10% and it's expected to continue to grow at 10% a year, then we can probably be willing to pay a PE of around 20. As a rule of thumb, there's going to be other things that come into this. If the business is not very predictable at all, if it's quite a cyclical business, or there's a lot of competition and things like that, a lot of uncertainty around that growth rate, the PE ratio that you're going to be willing to pay is going to drop. But nevertheless, this gives us quite a cool rule of thumb in terms of what we should be willing to pay for a company. So just to run you through a bit of an extreme example, in the tech bubble of the early 2000s, there was a company called Yahoo. I'm sure everyone's familiar with Yahoo, and you might even use Yahoo Finance and those sorts of tools as well. In the first part of the century, Yahoo was selling for a PE ratio of 10,000. And this is one of the craziest PE ratios you probably ever see. If the earnings for Yahoo stayed constant, it would take you 10,000 years to get your money back. That's far too long for me. Hopefully it's far too long for you as well. So that's something you got to watch out for. And obviously people weren't willing to wait 10,000 years for them to get their money back on Yahoo. What they were expecting was insane growth. But when you actually run some numbers on this, what you realize is that for Yahoo to eventually get down to a more reasonable PE ratio, let's call that, say, 20 to 30, because eventually that PE ratio is going to have to mature. The company can't grow to infinity forever, so the PE ratio will tend to come down over time for these really high-flying, high-growth stocks. But even then, if the PE ratio was to get down to 20 or 30 by around today's date, or so 2019 or even a bit earlier, the earnings for Yahoo would have had to have been equal to the entire GDP of the United States. So as far as I'm concerned, if I was in 2000 and someone told me that Yahoo's going to have the entire GDP of the United States and this valuation makes sense, I'm probably going to be pretty skeptical, you know. Obviously GDP grows over time, so once you get to 2015 or 2020 or wherever that kind of timeline is, it's not going to be 100% of GDP because GDP will have grown over time. But it's still going to be a huge percentage, and that's really not realistic. People aren't going to stop buying groceries just so they can go spend money with Yahoo. They're not going to stop buying houses so they can spend money with Yahoo. They're not going to stop going to the movies so that they can spend money with Yahoo. So in this situation, 10,000 was ridiculous, and as you would have seen in the early 2000s, Yahoo's stock went down 90+%. So PE ratios are a useful kind of metric to get a quick and dirty valuation on, and to sort of see what the market is expecting in terms of growth. So if a PE ratio for a company is high, probably those investors are expecting a lot of growth. If it's low, they're probably not expecting any growth at all, and they might even be looking at declining earnings. So it's a useful metric, and one that's flown around the place a lot out there, so one you definitely want to be familiar with. So I hope that gets you up to speed on the PE ratio. If you enjoyed the video, give me a like, hit subscribe, and I will see you in the next one. Cheers.